The world is changing fast. New technologies are impacting how we think about products, services, and the way we live our lives. Nowhere is this trend more present than in financial services, where new business models and customer expectations are changing our conceptions about banking, finance, and the very nature of money. Welcome to Rebank, a visionary podcast about banking, fintech, and the future. The future of banking is here.
Hello and welcome to Rebank. I'm your host, Will Beeson. Today we're joined by Lex Sokolin to talk through a few recent events that are indicative of the fintech world right now. Brex raised an additional $150 million at a slightly improved valuation versus its last round, just as Monzo is reportedly looking at a 40% down round. Why? Shopify launched bank accounts for its merchants and a new app called Shop, an Amazon competitor plus Klarna. At the same time, it worked with Facebook to support the launch of Facebook Shops and join the Libra Association. Lots going on. Lastly, Lex explains why Goldman's M&A activity over the past couple years leads to the natural conclusion that they should buy Schwab. For all of our past episodes and to sign up to our newsletter, please visit bankingthefuture.com. To receive Lex's fantastic weekly newsletter, visit fintechblueprint.com. Thank you very much for joining us today. Please welcome Lex Sokolin. Lex Sokolin, welcome to Rebank.
Great to connect again.
So we've been so focused on other things, you and I, over the past few weeks that we haven't had a chance to connect and just digest some of the most interesting stuff that's been going on. One piece of news that jumped out for me this week was the Brex fundraise. So Brex, I know you find them to be an intriguing company. I think many of us do. Such an interesting model. They launched during boom times, effectively extending credit to arguably otherwise uncreditworthy startups. And that has effectively been a powerful hook into other financial services. And they launched Brex Cash recently, I guess it would have been 2019 at this point, as a way of just deepening engagement with their core customer base, a customer base that previously really wasn't served hardly at all. I wonder if you have any thoughts on the fundraise and Brex more generally.
Do I have thoughts? I have so many thoughts, and it's been a weird couple of months because you'd think the quarantine would create this crunch for fintechs with high valuations, and it has for some. So Monzo and its 40% down round have been hitting the headlines. At the same time, we've seen a flurry of activity. Companies getting bought, companies continuing to raise unicorn rounds, and there's something about the current environment that's really catalyzing scrambling and potentially catalyzing venture investors doubling down on their portfolio bets. You double down on the bets you think are going to make it, and so Brex raising $150 million at a moment in the economy where small businesses are like totally and utterly decimated, seems to me like a high vote of confidence for their model. Alternately, it's just like, we have to save this asset. It's important to us from a portfolio perspective because it's so expensive. So to kind of to reframe what Brex is doing, as you said, is they started out giving out money to startups. Silicon Valley Bank is normally in that business, banking Silicon Valley startups and understanding the credit of what it means to help a young company that doesn't have normal cash flow. And Brex got into this game through a credit card that was an employee credit card. So let's say you have a team of 10, 20 people and you want people to be able to spend and for you to have controls over that spending, and then somehow to secure that with your startup equity or kind of venture funding. So Brex targeted that segment, very much a Valley company. And they were able to very quickly grow into a brand that lots and lots of people in Silicon Valley knew, understood, and respected. To me, it's sort of a funky thing. It's not even a secured lender or an online lender that has a deep understanding of sort of personal credit. It's really just handing out credit and money to companies that are very difficult to bank, and seeing a valuation justifying a $150 million check, which would be multi-billion dollar valuation, is super weird. In particular, it's weird based on a comparison, and the comparison is OnDeck. So OnDeck is a small business underwriter. It's a fintech credit company, and OnDeck is also a non-bank company, the way Brex is a non-bank company but wants to provide banking services. And OnDeck is publicly traded. When they IPO'd, they were worth over $1.5 billion. Today, they're worth $45 million. And the reason they're worth $45 million is like all the fintech stuff makes them more efficient and they can serve small businesses better and all the good stuff. The reason they're worth $45 million is small businesses are completely crushed and the debt is completely unpayable and their loan portfolio is shedding millions and millions of dollars of value because of the reality that your coffee shop is closed. And so you look at like a mature business like OnDeck, which has all this credit exposure and good technology and just a completely crushed valuation. And there, like in my mind, there's just no way that a Brex should be more valuable than a company like OnDeck. But there's a 10x difference today, I think, in what those valuations are.
Yeah, well, it'd be great at some point to connect with a real venture expert, valuation expert. Maybe we can get one of our friends on at some point to talk us through why that makes sense, looking through the distortion goggles of venture investing. But the one piece, I guess, that does immediately jump out, not that justifies valuation, is that Brex offers additional products around lending to its customers, which I don't know if OnDeck does, but I think of OnDeck as being a kind of a pure play SME lender. And I think there's some interesting pieces in here. One which might lead us on to another topic, which we can discuss, Shopify and some of the recent announcements it's made. But with Brex and with the cash account, this is, if I think back, a point that I floated around WeWork, rest in peace, would have been, I don't know, like probably a year plus ago. In my mind, there was this phenomenal opportunity for WeWork to basically offer business banking accounts and corporate cards to all of its business tenants and encourage them to use that for payroll, for expenses, keep obviously your cash balances in the WeWork account. So if you're WeWork, or if you're Brex in this example, you're generating transaction interchange and you're generating float on deposits. It's free revenue if you're already core to the experience that your customers are having. So WeWork didn't go that route, but I believe we'll see an increasing number of brands, of companies do that. So one, this week, maybe this week and last week, they've been active lately, Shopify. So Shopify is core to a very large contingent of online sellers. So basically, anyone who wants to easily set up to sell any goods they have across the internet, Shopify is the place to go. And Shopify ends up being the place where they get paid. And traditionally, the sole trader account is just non-existent, like a genuine banking offering that's tailored to sole traders, to one man, one woman businesses, be they plumbers or be they, online knitting salespeople. It just doesn't exist. So what Shopify is done is effectively stepped in and launched a business banking account in all effects with the opportunity to spend money on a card. And they're basically rolling this out to their merchants. So it is business banking, but it's a replacement for the personal bank accounts that so many of these merchants are using to run their businesses. And the interesting piece here is that they're kind of stepping in almost halfway through the traditional financial services value chain, which from the merchant standpoint, it's get paid, transfer the money into a bank account, and then spend the money out of a bank account. And if it's for your own personal needs, then you're transferring a portion of it into your own personal bank account and spending it that way. Here, you don't even need to make all those transfers. The money never needs to arrive to the final user account at the Barclays or Chase or HSBC or whatever traditional bank it would have been. You're effectively stepping in halfway through and saying, here are all the tools you need to do everything that you would have liked to do. And why does this work in the Shopify example? It works in the Shopify example because there's a dedicated critical mass of users who all have this need. And importantly, there's cash coming in. And I think if you kind of expand that to think about other potential verticals, basically it's anytime there's a significant amount of cash coming in to a dedicated affinity group almost, right? Like in this sense, it's online sellers. It could just as easily be YouTube creators. It could be Spotify artists. That's kind of on the quote unquote merchant side. But similarly on the consumer side, it could be fans of a specific sports team. It could be Fortnite players, right? And like as part of the rewards that you're getting, part of the incentivization to use the Fortnite account is that you get benefits, non-cash benefits from Fortnite. So whatever you need to spend money on in the game, you get a discount. You get some of that for free. At the end of the day, what Fortnite in that case would be doing is offering some of its zero cost goods and services for free to its account holders as a way of incentivizing usage, debit spend, maybe it's credit spend, maybe it's deposit balances, all of which again are net new revenue items, which are for anyone with a genuine following like that, significant from day one.
Yep.
So it'd be fascinating to see where this goes.
Yeah, and I think if you zoom out for the underlying trends, the last month has seen an incredible increase in online shopping and online engagement with different video games and platforms. And so you have like this gold rush to build more commerce into the web and into mobile. And so what Shopify has done, to me, is a really strong move. They were the back-end infrastructure for a whole bunch of web commerce, and it wasn't really their brand that was in front of people. It was the brand of the merchant. And now they've launched an app, a mobile app, which is called Shop, which is like an Amazon competitor. It's a straight-on Amazon competitor. And they just took and they aggregated all of that footprint of all of the merchants across all the different products that they power. And just like wrap their name around it. I mean, you can imagine, like WordPress, the website maker, or Squarespace, the website maker, launching an app called Squarespace, and instead of a website maker, it's just going to be like all the Squarespace sites internally, as features. And so it's just a huge flip going from a provider of infrastructure to being a platform, a destination.
They also launched Shop Pay installments, basically, pay after purchase, akin to like a Klarna or an Affirm, but it's, paying for installments if you're the consumer, no extra cost, zero interest. I think the merchant pays a small amount, but it's effectively built into the checkout experience now. This is legit payments and fintech space.
Yeah, so it's a total flip, right? From being behind the scenes, like we'll help you launch your brand and your experience, flipping then into a branded platform to capture consumer attention, which is like way more value, which is what Amazon's strength is, and then like Stripes in there, and all of these other enabling things are in there, and so building in finance as a feature, and this is something that we've been talking about for years, where embedded finance is just a feature. Like is there really a reason for financial brands to exist, or is it just a generic, right? Like, is there a reason for Tylenol to exist as a drug brand, or is it just ibuprofen that you buy from a drugstore and you don't care where it comes from? And I think finance is like ibuprofen. Like, I don't care where the banking comes from. And Shopify's banking, it's not a Shopify bank, it's a third party. They're renting a bank, they're renting banking as a service. You go back to Brex, they're renting their bank. It's not like the Brex's bank account. It's, I think, Radius Bank that's supporting that. And it's the tech firms that are building all the infrastructure on top. So Brex is trying to build their own core banking on top of it. Shopify is building all the cash flow, the account management, the accounting, the routing, the reporting, the payment processing interfaces. That's the work of the tech firm to connect to the consumer, and then you totally disintermediate the financial service. And this is totally flipped. It's totally opposite of how a finance firm thinks about it, which is like, we got to go and get some core banking tech infrastructure so that we can run our deposits on it. And it's just such a weird flip.
The interesting competitive nuance here is that Shopify appears to have a close relationship with Facebook. And I think that Shopify was even involved in supporting Facebook with the launch of the Facebook and Instagram stores, which was another new announcement, no doubt COVID inspired, of the past week or two, which is a very similar model at the end of the day, to the Shop app.
Yeah. Which walled garden do you want to be in, right? Like, do you want to be in the Instagram walled garden? Do you want to be in the Shopify walled garden? It's really all these companies trying to put us into boxes.
And interestingly, Shopify also joined the Libra Association as a member, promoting and progressing that vision. So on the one hand, they're supporting, contributing to the ability, presumably, for Libra to eventually become a payment mechanism within Facebook stores. And they're also launching a standalone, effectively competitor. It'll be interesting to see how closely these offerings mirror each other, how much synergy there ends up being longer term versus how quickly they become direct competitors.
It's quite wild what Facebook has been able to do over the last several months. So they have Facebook Shops, like you said, which reaches into Instagram, which reaches into WhatsApp and Facebook Messenger for customer support. So they're weaving these consumer pieces into a customer experience for purchasing. And I'm sure influencer marketing is attached to this, advertising is attached to this. If you haven't seen their marketing campaign, it is so amazingly, I don't know who designed it. It's so silly because it focuses on this letterpress shop, like this shop where two craftspeople are using ink drawings on handcrafted like paper cards, to send congratulations or wedding stuff to people. And these artisans are being advertised for their lettercraft by Facebook, which has destroyed the entire content industry, right? All of the newspapers, all the books and everything handcrafty and paper based has been completely decimated by social media and news content on the web. And Amazon and Shopify and these platforms, which have subsumed e-commerce and standardized it, making mom and pop sort of shops completely impossible to stand alone without being involved in a platform. And so you've got these tech behemoths, and they're using the story of the handcrafted letterpress as a way to promote their quarantine e-commerce platforms. I just thought that was so disjointed and weird.
I guess that's what makes it quaint, and that's what makes it
Exactly.
material. Somehow a reminder, an invitation to reminisce about the days of yore before we were trapped in rental cars and bathtubs.
The perfect artifact would be to purchase a digital frame or like an iPad, and the iPad displays the letterpress card, and that's what you mount and plug into the electric socket.
All right, so the last piece I wanted to pick up with you was Goldman and the interesting M&A that they've recently done in the fintech space, wealth tech, I think, more specifically, and what we should be reading into this as it relates to their future positioning.
So Goldman's been trying to reorient their business from a very luxurious, elite, private brand into something that has a footprint across the entire country and is much more retail, much more maybe mass affluent. They're not necessarily using the Goldman brand for this. They're using the Marcus brand, but there are a number of assets that are being aggregated into that retail footprint. The reason for it, and I think Goldman saw the writing on the wall 5 years ago, if not longer, was that without a large deposit base like the one that JP Morgan has, or Citigroup, or Wells Fargo, or Bank of America, the businesses they hold, although unbelievably profitable and enriching for Goldman employees, the businesses they hold are very volatile. So investment banking revenues are very correlated with the market cycle. Capital markets revenues are also very correlated with trading ability and asset values. So they're very volatile. And then number two is they're all in a secular decline, meaning that the pricing within capital markets is collapsing because you have electronic trading and all sorts of other models like the Robinhood model, pushing on the price of what it costs to trade either in equities or in fixed income and so on. And so there's a secular trend to collapse profit pools in capital markets and in investment banking. As you know, a whole bunch of Silicon Valley companies have been trying to do direct listings to avoid the banker fees. Long story short, there's a lot of risk embedded in the pure investment banking model, to the point where lots of articles today are saying BlackRock is the king of Wall Street, that BlackRock has the asset manager footprint of whatever it is, 5 trillion in assets, and that is who matters in 2020, and that is who has taken the top spot in financial services relative to 15 years ago, where it's the Goldman Sachs and the Morgan Stanley and the Lehman Brothers that mattered from a finance perspective. And so Goldman's been trying to position to have this deposit base and to provide investment services and to build bridges into lending and wealth and all of its different pieces. And so it's spent over $1 billion in order to get that done. Marcus, the lending company. There's also a company they bought for I think $750 million called United Capital, which is a financial advisor, technology plus sort of terrestrial footprint. Lots and lots of financial advisors using that software and a meaningful amount of AUM flowing through it. They've also purchased a couple of digital wealth plays. One is called Honest Dollar. Another one was, I forget the name, but it was founded by one of the
Clarity Money.
Clarity, exactly. One of the Dell brothers. And just this year, they bought two things. The first one was Folio FN, which is a $10 billion custodian for RIAs, for independent RIAs. It's $10 billion is very small in the RIA game, right? So TD is 500 billion, Schwab is over $1 trillion, Pershing is, I believe, $1 trillion or more. And so 10 billion is very small, but it's a gem. People really like the technology. And so they bought Folio FN. And then if you do a little bit of digging, Folio FN also, just a couple of weeks before, had acquired the client accounts of Motif Investing. Motif Investing is a direct indexing company that Goldman funded almost a decade ago. And the team from Motif Investing ended up going to Schwab. So the founder and the tech talent ended up going to Schwab, which has a direct indexing program, which is called Slices. And it's really about this kind of retail investing market. But then the IP and the clients went to Folio FN, or maybe the IP went to Schwab. But Folio FN got the clients, and then Folio FN ended up being purchased by Goldman in a sort of really weird tri-party transaction. And so that got me thinking that basically all the stuff Goldman's doing is at the edges, and it's buying high-performing assets at the edges of wealth tech. So yeah, $750 million is a lot of money, but compared to Morgan Stanley buying E-Trade, like, it really does not matter at all if you spend $750 million on United Capital. And compared to E-Trade, again, it doesn't matter if you buy Folio FN. I think what matters is a large transformational acquisition which bolts onto Goldman a real footprint, which is why I kind of started thinking, like, if you were to run Goldman, which is about $60 billion in market cap, what can you afford to buy that would get you on the same footing as Morgan Stanley E-Trade or Bank of America Merrill Lynch or JPM with its footprint? And I think they should just get it over with and join forces with Schwab. Schwab's a leader for sure in online brokerage. They've got an amazing customer footprint, but they're very retail, and they know how to do the web and how to do mobile right. And they cost about $40 billion. And so I'd love to see that transaction come to fruition, because I think that would really be a pretty powerful firm.
Love it. What an interesting idea. I would say thought experiment, but who knows? Perhaps it's not. I mean, it actually makes a lot of strategic sense.
You heard it here first, yeah.
Very compelling. All right. I think that's all we have time for today. Fantastic to connect with you, Lex, as always. I highly encourage everyone to subscribe to Lex's newsletter, The FinTech Blueprint. Lex, where can they find that?
fintechblueprint.com.
Excellent. Lex Sokolin, thank you very much for joining us today.
My pleasure. See you next week.
Thanks for tuning in to Rebank. If you like today's show, reach out. Follow us on Twitter at Rebank Podcast and join the conversation. For more on banking, fintech, and the future, check out our regular content at www.bankingthefuture.com.